Hi, I'm Diane Lim, and I am the Vice President for Economic Research at the Committee for Economic Development, which is part of the Conference Board. And I'm here today with one of our CEO members, Brian Murdock, and we're going to have a little conversation today about retirement savings. But Brian, let you introduce yourself to the audience and also tell them a little bit more about your company.
Sure. Thanks, Diane. I work for a strategic investment group. We are one of the leading outsourced chief investment offices in the U.S. What does that mean? OCIO really is an asset management business, but it's more than that because what we typically do is take over the entire portfolio of an asset owner. So not only do we manage the money, but we're responsible as a co-fiduciary for establishing investment guidelines, for setting asset allocation, and all of the sort of back office reporting, audit work that goes along with that effort.
So you are very heavily in the business of saving, the private sector saving and
Absolutely.
investment industry.
Most of our clients are institutional clients, but the assets they have in many cases represent pension accounts or other sorts of savings vehicles. Absolutely.
Yeah, so you were telling me the other day about how your company and your work weathered the storm of the financial crisis and the changes you saw, and I found that fascinating. And I was hoping you could tell the audience here a little bit more about what you've seen happen as a result of the financial crisis and how retirement savings, personal savings more generally has changed because of it.
Sure. Well, the first effect obviously was during the crisis. And I think the average saver or long-term investor for that sort of need was not well served by a lot of the advice that they were getting. I don't mean that to be a broad-based indictment, but for a lot of investors, they got caught up in relative investing, very product-centric type solutions that was really more about the economy of delivering a scalable product to investors without actually solving their immediate needs. The average person doesn't really care about relative performance and probably shouldn't be all that concerned about what the S&P 500 is doing per se. Those benchmarks are good, objective ways of measuring relative results, but at the end of the day, individuals should have a goal of savings towards some sort of target or liability, and they should be matching that. And so the focus should be more on total return and less about a relative performance. And they need to think about what are investment solutions that meet their needs rather than investment products that they can purchase. The challenge is the average saver doesn't have the quantum of money to attract the kind of advice that they need, and so what they wind up purchasing is what we call investment products with embedded advice, where the advice that they would get is sort of embedded in the way the product is structured, and that's what they get. The challenge in all that is that frankly they just don't understand what they purchased, they don't understand what they're paid for it. It's just a lot of confusion. And really well-educated, really smart people still don't really know much about how they're investing or how their money's being handled. And so simpler solutions that are more transparent and more tailored for the individual rather than built around a lot of the intermediaries who are involved in this industry probably would be an advantage. And I think what you saw in the crisis was a lot of rebellion against the risk, where the average advice giver probably has a healthier appetite for risk, and the average individual doesn't want enough as much risk. The answer is probably somewhere in the middle, because the investor is too risk averse and the advisor may be too aggressive. But you need to have a conscious decision about the risk you're taking in order to get the returns you're pursuing.
So what has changed, though, in terms of public policy as a result of the crisis, in terms of, is there greater regulation that oversees the provision of, the mix of risk versus return for consumers that may not fully understand what they're getting themselves into in terms of investment advice?
My honest opinion is that there hasn't been a lot of effect to it at regulation at that level. There has been an effective infrastructure around the way we invest in capital markets that goes back a long time, and that's provided some safety for investors so that there's a segregation of duties, so that custodians can maybe separate from the people actually managing the money and so forth. And there's standards around disclosure and around granting discretion and all those sorts of things. So those work pretty well. And I would say as the principal savings vehicles are either bank savings accounts or mutual fund accounts, and now ETFs. Those are high functioning, well performing potentially well-functioning vehicles for savings. But the question is, what do you put it in order to get that kind of return? And the challenge that's happened post the financial crisis is less about the structure of environment, it's just the opportunity set. With zero interest rates environment, you have this incredible problem where people, it's in a very complex world, the one thing that's clear and obvious to everyone is they're not getting a very good nominal return on their money. And they're desperate for it to get a greater return. So that's the challenge that's come about, like say, the last 5 years. And that's really a function of monetary policy that is pushing interest rates down to almost zero.
So do you think, I mean, if we look back to before the financial crisis and before the Great Recession, a lot of economists felt that the personal saving rate was way too low.
Correct.
And maybe that the risky behavior was too high. Don't know. I'm interested in your opinion. I'm curious about like what has happened since the Great Recession and the financial crisis. Do you think people are still not saving enough? Do you think they're still investing in their strategies are too risky or not risky enough?
So there's a bunch of different things going on. If you look at the history of the way people would save in, say, their 401k, their defined contribution plans, absent guidance from the plan sponsors, all the money would default to cash. So clearly that's an inappropriate investment solution for anyone unless they're about to retire. And so that was a big problem. And so one of the big improvements when you had the Pension Reform Act of 2006 was to allow plan sponsors to not only to give guidance and to default savers in those DC plans into more long-term, I won't define it as riskier, but long-term oriented investment vehicles rather than just sitting in cash. So that was a very constructive thing that's come out of that. But post the crisis, most of the regulation has been Dodd-Frank, and that really talks to institutions really looking at the, for better or worse, how banks and other financial service institutions are organized around either their balance sheets or how they're servicing customers, and less about what's happening or in any way a solution for clients per se. But it is true to see that based on the crisis, that individual balance sheets have been improved. They've been deleveraged. And so one of the pre-crisis mistakes that people were making, and it wasn't just assumption of risk, it was misallocation of investment focus, which was too much on real estate. And that was, and that, if anything, I would say the legacy that goes back a couple of decades of government policy to subsidize or encourage personal property ownership created a unintended consequences that built up to really was really the core of the financial crisis.
Yeah, in fact, I think a lot of people, for a lot of households, their house was their largest asset.
Still is, I think.
And well, for many households, their home property value went way down, so they lost a lot of that asset value. But yeah, I thought, I think that caught a lot of, that was a big wake-up call for a lot of households. It was like, wow, I thought I was saving a lot more because I thought my house was worth a lot more, and I've been borrowing off the home equity to pay for other things. And so I think that was a huge shock on the personal financial situation. You mentioned DC, defined contribution plans, and that's, of course, part of a longer-term trend away from defined benefit pension plans to defined contribution. And I was wondering if you could talk a little bit about that, because in my mind, defined contribution, or the movement toward defined contribution, puts a lot more responsibility on the individual to actually care about, pay attention to how they're saving, right?
Absolutely.
Defined benefit, it's sort of like, oh, it's just automatically part of your job, and they'll do the saving for you, and they'll promise a retirement income for you, right? Defined contribution, you have to contribute, so you have to more proactively decide how much to contribute, right? And understand more about what that means for your future retirement income. How are you seeing that trend play out over the past several decades? Where do you see it going? Do you think people are being proactive enough in their own defined contribution decisions?
Well, so it is a mega trend, and the trend as we currently see it will continue, which is really a sense of shifting the liability from a corporate balance sheet or the sponsor balance sheet to the individual participant.
Right.
So that's really the major change, is that if you're the sponsor, whether you're a municipality or a private entity, you carry this liability on your balance sheet as a promise, and that dissipated over time because people don't have lifetime employment objectives anymore. And so as an employer, why would you wear the burden of that liability for, in many cases, employees who don't even work for you anymore and who aren't actually assigning a lot of value to that? So the liability was shifted, started about 25 years ago, and it's been accelerating. In the private sector, active open pension plans are almost unheard of. And so for what was called the greatest generation, they may be also the last generation to really enjoy a traditional benefit plan, a traditional retirement, the way we think of it. For baby boomers, it's kind of a mixed thing, and for millennials, they won't even know what we're talking about. They won't know what DB will mean anything to them. So clearly, as that liability and responsibility is shifted to individuals, then they need to think more proactively about their savings. And the math is so dramatic for a person who begins that process at 25 or 35 or even 45 than in someone who's in a pre-retiree mode and thinking, oh my gosh, I'm retiring at 15 years, what do I do?
Right, the miracle compound
It's
interest.
unbelievable.
Right.
Okay, and so education is important. Creating the right structure to encourage that is great, and the ability for all employers to set up a plan that provides that vehicle, and to make those vehicles can roll over or migrate with the worker, and they begin maybe with the millennial generation. They have a mobile phone, they have a mobile IRA, and they think about those two things as something they port with them everywhere they go, and realize even small contributions at a young age can compound into a meaningful number later on. Whereas you have a lot of pre-retirees now that I call the baby boomer generation, their probably only hope for supplementing their Social Security on average will be reverse mortgages, because that's where they really have their lifetime savings. It's in the equity of their property, and I think the average retirement savings for even a more middle-class cohort is something like $40,000.
Let's talk a little bit about the behavioral economics aspects of saving, right? Because there's been a lot more effort with this rise in defined contribution plans of employers to sort of help their employees save better by making it more of a default option when you start a job that says, okay, we're going to automatically, if we don't hear back from you, we're going to assume we're going to put X percent, 3% of your paycheck automatically into the retirement savings account unless you say otherwise and opt out of that. We're not forcing you, but this is what we'll set up as a default option. And then has that had a positive effect?
Oh, the data is compelling. I mean, the data is just dramatic that if people are defaulted into the plan on the day they're employed, and they have to basically have a negative consent to be withdrawn from the plan, that they rarely do, unless they're really counting on some sort of a net number. But as soon as the after-tax paycheck hits someone's account, they begin to sort of baseline about that amount of money. And so it's really critical. I even encourage my kids, when you start a new job, put as much into all the saving vehicles they can, so when you see your first paycheck deposit, you realize that's the number, and then learn to live on that number, and it's much easier. It's very hard to extract income from an existing lifestyle after the fact. And so that kind of program has worked very, very well. And then the other pieces that have accelerated that is there are step increases over time that can be dialed in. Again, if you don't want it, it's your money and it's your account, and you can say no. But the fact that we're essentially boiling frogs very slowly here, so no one jumps out of the pot, that's a very effective policy.
I think it might be a combination. I think economists are wondering, does that default option work as a trick because people are lazy, or because people view the default option as signaling a social norm, a social goal,
That's
this
is
question. Right? So
a little bit of both.
Right?
There's an element of apathy. I think at the moment in time people will think it through, but then they forget about it. Even if, for example, we have all these mechanics and all this infrastructure around being able to select your investment options around your defined contribution plan, because after all, it's your money, you have that choice. But what the data shows is that people don't change. Some people are day trading their portfolios, and others set it and forget it for the rest of their career. And so that's why the advent of target date investing plans for defined contribution, which took off about 8 years ago, have really taken over, that they'll just simply pick a year in the future that says 2040 is a reasonable date for me to think about what happens to my savings. I put the money in there, and in some sort of balanced, thoughtful way, some other firm is figuring out how to make that all come together over time.
Right. So, in another behavioral economics sort of observation of mine, when you look at millennials, the young people just coming into the workforce, and you think about how the technology in the banking sector has taken off so much in recent years in terms of what you can do from your smartphone, for example.
Sure, absolutely.
I assume, and I've talked to my daughter about this, that the fact that you can check your bank account so easily, like on your smartphone, and you can see it growing, it's like positive reinforcement,
Can be.
right?
Assuming it goes up. With almost zero interest rates on cash, it's not as powerful as it used to be.
Right, but it's so easy, for example, for people to check their balance on their retirement savings account.
Yes,
so that
correct.
can certainly be positive reinforcement.
Can be.
Yes.
It's
so.
nice to, but it can be worrisome as well.
Oh, I see.
So there was a great article that was written decades ago about the cost of looking. And the argument was that the risk premium that was charged by equities over fixed income was a function of people expectation around high volatility. They would watch it more closely, and therefore you had to get paid a higher risk premium in order to justify being in that asset class. Whether people buy a bond, they just think about it maturing at a certain date and not thinking about the risk that's also there. So I'm not sure that's
like a little bit like
self-fulfilling prophecy.
Yeah, unnecessary medical tests or something. I don't know.
Yeah, so we don't encourage people to look too often at their portfolio. But it's nice to have that because it's a reinforcing mechanism that I think the behavioral part of it is that you have access to it.
Yeah.
That it seems real to you, it's tangible, it's something. It's
that
not
you have more control over too.
Sure, but something very obscure that you get this number on once in a while, you don't know what that means. Right. I mean, to get a report from a firm on your defined benefit plan, you don't know how to translate that into reality for yourself. Right. You show a projection for a 25-year-old starting working with a defined benefit plan 30 years out. They don't really know whether $1,300 a month means anything or not in $20, $45. So that's a real problem for them. But to have an account that seems tangibly yours, that you have ways of accessing it, whether it's a bank account or a savings account or a 401k account, I think that makes it more meaningful, more personalized, just like all the way technology has really personalized itself.
Do you think the young people are saving enough? Are they off to a good start in terms of
the data doesn't indicate that. The data
No?
indicates that they're burdened with an incredible amount of educational debt. That's another giant issue that we could spend hours debating.
Yeah. So, I mean, what do you think? So we'll set aside the student loan debate for another day.
Because that's a whole nother. But the fact of the matter is, it's just the massive wealth transfer from everyone's hands, mostly the parents of today's kids, to higher education is really almost unprecedented.
Right.
And the whole infrastructure is built around reinforcing that with subsidized loans and the requirement you have to have a college education for just about apply from every job. And so the thing is self-perpetuating, and if you're an institution, you know that you have a built-in demand for your product and a built-in price increase based on the fact that you've been able to raise the rates of the price of what you charge a multiple of inflation rate for about 40 years now. And that compounds to make a private undergraduate education cost $250,000 a year.
Yeah, well, you've just sort of described the whole portfolio, the entire portfolio of CED. But let me ask you, what, in terms of the retirement savings, sort of the more personal savings role of and the business that you're in your work, what do you see as a role for government? Like, what is government's role? Are they too involved? Are they not involved enough? Are there more things public policy could do to encourage adequate savings?
I think that people respond to structure and facilitation, and I think where the government can play a very constructive role is to creating more and more savings accounts, whether it's a health savings account, whether it's an IRA account, anything where it's automatically deducted on a pre-tax basis, so that at least someone who wants to be high functioning and thoughtful about it has the wherewithal to do that. Unfortunately, that is an important but minority part of the population. There's still a lot of people who either just don't think about it that way or simply haven't the financial wherewithal to take advantage of those programs. But to the extent the government does create those programs, they are very meaningful, and they do encourage savings. And so I think that the record on that has been a very positive one.
Do you think there are ways that the government can expand access to those kinds of programs, or are we just talking about, where's the money going to come from, and isn't that, can it only come from some other part of our economy?
Those programs are useful for people who have the capacity to save. Saving is hard because it's a deferment of desire and need to some future date. Not everyone has the ability to do that, but even a subset of those have even the discipline to do that. And so what government policy does is create a structure that makes it easier for the average person to adopt the discipline of setting aside current income for future need through these savings vehicles. So, to have more of those will be a very positive thing, and certainly not to in any way send a signal that those legitimate programs are somehow in jeopardy. Because you do hear that sometimes also, and that gives people the ready excuse to say, well, there's no sense putting money in this program because someone's going to come along and change the rules later on.
Right. Okay. Thanks, Ryan. This is a great conversation.
Appreciate it.